I think you want to find founders who are irreparably broken, so they're just going to keep charging forward and build. And my, bond with them is that I'm the same way. And so I'm not here giving you money trying to take advantage of what's broken about you. I'm saying, hey, I'm broken too, and living this path fulfills me. It can fulfill you too. Let's go on it together. That was a hard lesson to learn because I invested in a couple companies that I watched as their direct competitor became a monster. And I'm like, I knew that was going to be a thing. I knew it so early. But what I really fucked up is that the only thing that really matters is people. And the general thesis behind it is that Seattle should be a much better place to be a founder than it is. And coming out of COVID, with the rise of large language models, it was embarrassing to watch sort of the phoenix of SF proper, with YC leading the charge. And when we're sitting here and be like, we're not going to replicate that, but the difference is insulting. What I was finding was this desire to work and build around others, to engage in a community, but also this desire to leave Seattle, which was not a good thing for our ecosystem. So the idea for Foundations was, and can we kickstart a flywheel that'll make Seattle a better place to be a founder? And so the ingredients that we took together was, we need to anchor this around a physical space, because that's something that all three of those categories needs right now.
Hello, everyone. Welcome to Startup Project. I am your host, Natraj. Today, my guest is Aviel Ginsberg. He's the founder of Simply Measured, which was acquired by Sprout Social. He was managing director at Amazon's Alexa Accelerator. He's also a general partner at Founders Co-op, and he's now co-founder of Foundations, which is a shared workspace / accelerator, or an anchor to Seattle's VC ecosystem, or trying to be. We'll get to Seattle Foundations and everything about it, but I think a good place to start this conversation would be, one of the best episodes of Startup Project was Chris DeVore, your partner from Founders Co-op. We had a really great conversation, and I've been following Founders Co-op's work and Chris DeVore for a while. How did you get to start work with Chris DeVore?
For better or worse, my entire career has been wrapped around Founders Co-op and has involved Chris. So I graduated college in 2007, sort of at the beginning of the Great Recession. Knew I wanted to do something in tech, thought maybe I wanted to do something tech and finance. I was from the East Coast. The plan was to go to New York. And I mean, everything just went to shit. Like, all of my peers who were graduating were having all of their jobs pulled. Like, everyone did the proper, internship at Goldman and other stuff, or I'm going to go work at this company, and, rugs just pulled. So I said, I had been building, I wouldn't call them startups. They were more like small website businesses throughout it to pay my bills in college. So I just said, okay, fuck it. Let's go all in. Let's do this. And so me and a buddy decided to found a company. And before we closed on the friends and family money, I realized very quickly that we were just about to lose all of their money, because we had no idea how to actually start a startup. Like, we were reading TechCrunch and being like, yeah, let's do that. But neither of us had worked at one. We hadn't even really talked to someone who had been there and done this. So I said, I got to go west, and I got to see what this is like. I didn't know anyone in SF. But I had one good high school friend who was at Microsoft. And so I wound up in Seattle not knowing anyone. And, interestingly, about less than a week after I started, there was a startup weekend. And startup weekends were very different. In fact, I don't know if they even exist anymore, but what they were back in the day then was like, everybody gets in a room and builds together. So there was just like 150 people from, early Amazon, Microsoft, the budding Seattle startup ecosystem. They're like, okay, let's pick an idea, and then let's form divisions, and we'll all build together. You know how insane it is to get 150 people to work on the same thing at once? Like, it's hard as a company, but nobody knows each other. You're trying to ship something in 2 days, like, complete shit show. But I raised my hand and I was like, oh yeah, I'm a designer. I'll lead the design department. Was I a designer? I don't know. I could design shit. My dad's an artist, but I was more confident than everyone else who said they were a designer. So I, found myself rubbing shoulders with what eventually became sort of the who's who of the Seattle tech community. And out of that, I immediately landed a job at a company called Aperture, which was funded by Founders Co-op in Madrid. So within 2 weeks of arriving in Seattle, I was right in the middle of that community. So I got to know Chris as I was working there, and he got to know me and knew that my plan was always to start a company. And I was clear with the founders that like this is for me to learn. This is wonderful, but like there's nothing you can do to actually keep me. And I was lucky enough to watch that business work. I think so many people start their career at a startup that goes absolutely nowhere, or at a big company where you're just sort of stuck in a tiny little hole and you don't see the broad spectrum. I was able to, on day one, write code, design products, talk to customers, act as a product manager. I mean, that company went on to sell for over $100 million, but I was just like, my first 2 years were like, holy shit, like this is what stuff working feels like. And when I felt like I had enough confidence to go out and do something, sort of paired with the fact that I think what makes founders is that they just can't not start something. Like I was spending nights and weekends with my best friend working on anything we could hack together with Twitter data, Facebook data, like all these new open APIs. Because one of the biggest challenges was like, you can do interesting things with data, but you couldn't get data. I know that's so weird to think about today, but 15 years ago or 17 years ago, rather, it really was. So I said it's time to go off and start a company, but I don't know exactly what it's going to be. And Chris and his then partner Andy were like, "Yeah, we like you. You should do it. We'll just write you a check." So we incorporated as Untitled Startup. That was sort of the precursor to Simply Measured. Chris made me put together a pitch deck that he ripped to shreds and made me feel like he wasn't going to invest in me, but he did anyway. So I transitioned from early employee at a Founders Co-op portfolio company to founding CEO, which then transitioned into head of product and engineering of a portfolio company. But as things went on, I was finding that like I was much more interested in the 0 to 1 of things, like going from idea to MVP to customer traction. And so I was naturally spending more time with Chris and Founders Co-op than I think a normal portfolio company does, offering up my time to do technical diligence, to help with perspective on the MarTech industry, which is where I had been and where we were placed. So I found myself immediately wrapped up inside of as like a pseudo venture partner, which turned formally into a venture partner in 2014. And then when we went on to sell Simply Measured, transitioned into a GP role. So it has been in some way, shape, or form 17 years of working every possible seat inside of the Founders Co-op portfolio. And now these days it's just Chris and I working together and investing in new companies.
So talk to me a little bit about like what is Founders Co-op doing right now? Are you guys actively investing? At what stage are you investing? What size of checks are you writing?
Yeah, so we are at the tail end of our fifth fund, which is a $50 million fund. Average check size about $1 million and a half. Investing in pre-seeds and seeds in the Pacific Northwest mostly. COVID sort of screws up what geography really means, but we find that we gravitate towards founders who are culturally Seattle. So what that means is like you learned how to build at an Amazon or a Microsoft. You gravitate more towards unsexy business workflow problems rather than, flashy consumer products and things along those lines. And we'll be doing the first close of our next fund within the next month and are actively deploying and in business. I think that the thing about us is, neither of us are finance people. We're both founders ourselves. We never worked at a larger venture firm. We have no associates. There's no one else who's involved in the fund. We have a lot of small LPs. Like we act very much like a startup itself, or it's just hard. We are absolutely a venture fund. We have LPs. That's how we operate. But our process, I think, feels more like interacting with a former founder who's deploying his own capital into really early stage things that they find interesting.
One thing, I was listening to a conversation on Shift AI, and one thing you mentioned was you were sort of did these things overlapping. You were an investor while you're a founder, you're sort of a venture partner at the same time. I feel like we have that in common. Like I do a bunch of things. I invest, I work at a big company, but I also do a podcast, which I could relate to doing multiple things. Talk to me about how your thesis of investing and finding companies evolved. Like when I talk to someone who comes new into the venture community, they'll give me a list of bunch of things on, this is what I think. But over time with experience, then they'll realize that, okay, you have no data to judge all these things. And they completely realize that, okay, this is more of a science than, more of an art than science. Talk to me about like what your decision making of like, okay, I have to invest in a particular founder or a company.
Start with picks I made initially. So like it's a great point of like people come in with a perspective from either the other hat that they're used to wearing. Maybe they're still wearing at the same time like I was. So for me, when I was starting to make investment decisions as part of Founders Co-op, I was still actively operating. And I was anchoring too much on product as well as what I would do if I was running the company. So I was thinking way too much about the product itself, the customers, and the opportunity rather than the founder themselves. And that was a hard lesson to learn because I invested in a couple companies that I watched as their direct competitor became a monster. And I'm like, I knew that was going to be a thing. I knew it so early. But what I really fucked up is that the only thing that really matters is the people. And I just did not yet have the pattern matching to know what are the behaviors and motivations that make a great founder, because so much of success is about luck, is about upcoming challenges that you aren't expecting, things that are out of your control. And I was much more bringing my perspective of like, I know what good product looks like. I know how to take things to market. That's what's going to make me a good investor. And I think, frankly, I had to that made me initially a bad investor.
It's also like whenever there is a thing that you see, like even now in AI, certain type of companies will succeed, but now you have 5 competitors in the area. Who are you going to invest in? And are these investments as an angel? Because sometimes as an angel, you can do, multiple similar companies. Well, funds have sort of a little bit of more.
All as the fund, and I think that becomes a piece where I think you can run a strategy if you are a thematic fund, you have enough dollars, enough access and structure. You can be like, I see everything in the space and I pick the winner. I think it's hard to do that at the pre-seed and seed stage. That tends to be a thing that more like Series A and beyond investors can pull off. But I think, at the pre-seed and seed, there's venture funds like Amplified who are able to do that across, the entire infra world. But I think ultimately as a seed stage investor, your job is to get really good at identifying a very specific type of founder, be good at knowing how to help them along the way. Like, what are the good parts and the bad parts of their personality and motivations, and just focus on those folks and don't feel FOMO about missing out on other things. Don't feel FOMO around a specific thesis. Like, I think that's just like a losing strategy. And in fact, like it's like embarrassing to look at what a lot of folks will do out there. Will they'll put out like a whole, we're all in on AR, VR. We're an AR, VR fund. Here's what we're doing. Yes, no, fuck, we're a crypto fund. We're AI, we're crypto again. Like, what the hell? Like, and I mean, at the same time too, then you'll ask folks who even stayed somewhat consistent, and you're like, how'd you know to invest in that company? Like, that was a great business. And then you learn pretty quickly that the company did a 180-degree pivot after they invested. And so the whole reason why I was even in the fund is completely wrong thing. So, like, look, ultimately, early stage investing is like casino level risk in people. Like, that is what you were doing. And the reason why it works is that you make enough investments that something does work and takes care of the rest and forgives all of the sins of the horrible investments that you made. And how you become good at it, how you de-risk that casino level risk is, I think, ultimately just through having enough experience with enough founders seeing the movie play out enough times. So alongside, you mentioned the Amazon Techstars program, I was part of the selection committee for Techstars Seattle from 2010 through 2020 as well. So I have seen hundreds of companies, actually, if we're doing selection, thousands of companies from, pitch to did they make it, did they not, to some even IPOing. And so ultimately, when I look at a founder, I look at how they're tackling an opportunity. I look at sort of the shape of the market and the market opportunity as well. I can pretty quickly say, I can see all the different directions this can go. I don't know which it will, but I can sort of take that very broad spectrum of future possibilities and break it down into something smaller and say, okay, how do I take that risk with my existing portfolio, with where else I want to take on some risk, and assemble something that ultimately can't just wash out to a full zero. But what you are looking at is really just the human and the market that they're going after. That is what you're underwriting. That's it.
I mean, you mentioned pattern matching, right? Are there any specific, like, one or two things um, that are like deal makers or breakers when you look at certain types of founders?
Yeah, I mean, I would say motivation matters a lot to me. Like, why are you doing this and where does your energy come from? And a lot of times I think the folks that have that infinite renewable energy resource are those who are building something because there's something broken in them and they're just filling a leaky bucket for the rest of their life with creating something new. And they find happiness and satisfaction in the work, in building, not in a specific technology, a specific customer set, a specific product. They just have to be putting something into the world, or they're falling apart. And like, I mean, so that's you work with crazy people. And I love that. I mean, it's funny too, where it's like, I think, you know, mental health is a big factor, I think, in sometimes the wipeouts that happen where like depression's real, manias are real. We're working with crazy people. Like I live this as a founder, high highs, low lows, real depression. But at the same time, your job is to ride that wave as a founder, where it's just like, you know, you don't want to find someone where, you know, people joke on Twitter about founders getting like one-shotted by ayahuasca and finding peace and happiness, no longer being motivated in their company. Like, there's that version of it, but like, I've seen it happen the other way of like, oh, I discovered the love of skiing and now I'm just really into skiing and I have a family and I ski and I found balance in life and I no longer care if my company succeeds or not. Like, there's all those different elements. And I think you want to find founders who are irreparably broken. So they're just going to keep charging forward and build. And my, you know, bond with them is that I'm the same way. And so I'm not here giving you money trying to take advantage of what's broken about you. I'm saying, hey, I'm broken too, and living this path fulfills me. It can fulfill you too. Let's go on it together.
I think that's a pretty good way to put it, because I mean, yeah, there has to be a place where this motivation comes from. Because because I grew up in India, and when I came to the US, and you know, people criticize, you know, now the US people criticize the Europeans, right? But when you come from India, the Indians will criticize the US people because they're too soft. And then I was always of this perspective that why, because entrepreneurship in the US is so de-risked in a lot of ways. Like, you could take the only risk you're taking is mostly on time. If you're like, let's say, a developer and working at a big tech, you should technically not be working at there, especially when you're young and doing a startup, because it is de-risked. You will find some seed money eventually if you have some decent idea. And what I thought was, the Indians who come here are a bit more broken by their childhood, right? They have more motivation. Well, if you have a really stable childhood, which in most modern world it is, then that motivation doesn't exist. They're happy doing what they're doing. The happiness quotient is different. So if they have higher happiness already in life, they're not motivated to do this. So I get the sense of what you're hitting at in a different way. Um, um, Talk to me a little bit about, um, you mentioned some funds investing in these narrow categories like AR, VR. Uh, it was clearly a sign of me not just having more capital on the startup side, but there was so much capital that there were funds with inexperienced fund managers being created left and right. Talk to me about that debt. I think maybe it was like 2020, 2022. That is probably both startup side and as well as fundraising side. We have created a lot more new funds, which will never be successful as well.
Money became functionally free, right? And I think so. What you're suddenly looking at is like, if money is free, where do I find alpha? Like, where do I go? And when you run out of ideas, you say, well, the best place to put that money is in the unknowable, is in things that don't exist yet. And that obviously led to an outrageous amount of first-time funds. And now an amazing thing about first-time funds, and I lived this sort of as a first-time, it wasn't first-time fund, but me being a first-time VC, is I'm bringing my network with me. Like, and I haven't yet saturated it, right? It's like, who are all these amazing, smart people I know from my operating days? Now let's all give them capital. And I think with that, that also makes it look better than it really is, because somebody can easily, let's say, get 20 million. They get $20 million, and then they immediately are able to deploy it in all these awesome companies, or at least awesome looking companies, because they know the right people. It's like my buddy who just left Stripe and is doing this and this and this. And then an outsider looks and is like, holy shit, this guy's a great investor. But then at the end of the day, you're like, wait a second, like, this isn't really a venture capitalist. This actually is just someone with a great network who didn't have any capital and now has capital and just deployed it right into their network. And, he or she was not being thoughtful about, is there real business? Does this make sense? But all of that was also masked by markups on top of markups, and people look like geniuses. So that's why that happened. And I think it makes total sense. But the second the music stops, a lot of those folks don't get money for their next fund. They lose interest. This is a lot of work. Like, the fun part is like the excitement you get around a new idea, a new person investing. Then you invest, and then it just becomes, it's all downhill from there, man. Like, I always say that, like, nothing ruins a good story like data. And the beginning is all, especially in pre-seed seed investments, like, we're going to go to the moon. This person's awesome. And then you learn, like, afterwards, you're like, it's like, she's
Not going
kind
to
of
the
an
moon.
asshole. Like, this business is terrible. Like, the fuck was I thinking? Like, this product doesn't even really work. Like, it's always like you have this high, and then it goes to shit. Like, dude, that first meeting you have, like the first investment meeting, you're just like, what is this shit? Like, it all, and you come into it being like, oh, I'm hearing some crazy noise. Do you hear that in yours?
No.
Went away. You come into that first meeting being like, how bad is it going to be? Like, Chris and I will do that. And then afterwards, we'll like immediately hop into Discord, and we'll be like, wow, that wasn't nearly as awful as I was expecting. Because that's just how it works. And then you build yourself out of the hole into a great company. And so, and that's where the real work is like showing up every day, helping founders problem solve, knowing when to stay the hell out of their way, knowing when you need to be super active. And that's the work. And, I think a lot of folks will not raise future funds. A lot of folks have just realized this actually isn't that fun or enjoyable and have moved on. But the side effect of it is there's a lot of companies that raise money that shouldn't have raised money. And we're still going, through that pain.
I think the biggest distortion was the opportunity size. Like, every idea was exaggerated to be $1 billion opportunity.
I would take that even further, is that people were like, it's not that everything can be $1 billion. Now there's $10 billion opportunities, because it was like unicorns went to decacorns. And that started to make the model work, which is like, well, then there should be a lot more early stage funds if they can be this big. And like, it's no big deal if the pre-seed's at 50 posts, because the company could be worth 10 billion. Well, if the company can only be worth 1 billion and you started at 50, your fund is fucked, like, at inception. So that has been a problem.
I think there's also this winners bias, and the set of winners that became the winners in the story were all like Mag 7 and all these $1 trillion companies. So now it's not just even in billions now. Okay, if this company works, it could be $1 trillion. Like, everyone will say now trillion, because now then you can justify a seed round of $1 billion, which is with AI companies.
I mean, and I think there are some areas where there could be winner-take-all market opportunities. So maybe you could justify something like that. But I think there's also something I've come to see over time is there is this illusion that great companies have an arc that looks like this. It's just constantly up and to the right. The company will always be more valuable in the future in a long-term horizon than it is today if it's a good company. Because like you can look at, inside a year of reports of Microsoft or Google or that company, but you zoom out and you just see the up and to the right. But things move so fast these days that I think there are amazing companies where their enterprise value is really this, and then it goes to zero over time because the world moves. And so part of your job there is you invest in the company and you have to know when to get out. And that doesn't mean that it's like value capture. It can still be value creation, but things need to die for new things to be created. So like I'll give you an example. We invested in a seed round, this company called Ally, which ended up selling to Microsoft. So it's OKR software. And we invested sort of right before OKRs took off and before COVID. So there was this like insane accelerant within the market. We were the mid-market company. There was a high-end company that Andreessen and Sequoia were both in. And then there was sort of a lower end coming up to mid-market that Insight invested in. So we went from like this category doesn't exist to there's now $2 billion companies, and we're raising money from Tiger, we're raising money from Green Oaks. We're on that exact same trajectory. Like what is happening here? We got approached by Microsoft for an acquisition. And at the same time, we had a term sheet from a fund that everybody knows. It was like, how about we just give you $100 million at a $1 billion valuation, even though you have single-digit ARR, because this is such a hot category. Come on, be a unicorn and do it. Many conversations with the founder about what's the right way to go. What's your motivation here? Do you want your software to impact millions of people? Do you want to be a CEO of a public company? Lots of contention and, disagreements, frankly, at the board level of what to do. We ended up deciding to sell the company to Microsoft. Now let's fast forward, call it 2.5 years, 3 years, I guess, after that acquisition. Microsoft acquired the product, put it into Microsoft Viva, made it Viva Goals. They announced, even though the product was doing well, they're just shutting it down because their strategy has shifted to co-pilots, and the way that all this works, they just don't care anymore. So the thing they bought for a lot of money, not quite what that $100 million term sheet was offering in post money, but not that far off. That product shut down. Those two other competitors are functionally screwed. They're trying to seed level pivots. I don't know how they ever clear the preference stack. And so you look at that and and if I'm going to go back in history to underwrite my investment on its head, like that was a bad investment. I underwrote a category that never came to exist. And there was not enough market opportunity there. So when I look at that investment versus an investment in a company I made, let's say 1 month later, that now after, call it 7 years, is just struggling, has $1 million of ARR, is break even, doesn't know where they're going, probably will end up shutting down. Like on its head, both of those businesses and categories didn't, but one of them returned nearly $1 billion and the other one is going to return zero. And like trying to reconcile that in this world is a crazy thing to think about. And so I think that is just important to go back to where this point began of like, underwriting something be like it can be worth $1 trillion. I think you have to think about that sometimes, even in a great business, the local maximum may be the global maximum. This is as valuable as this business will ever be for strategic reasons, because of acquirers, because of the market. Wow. And that's okay, but you have to operate as such. If you instead are saying like every business must be $1 trillion or nothing, you're going to be leaving a lot of enterprise value on the table, because I just don't think that's true.
Let me ask you this. Was that acquisition sort of a fund returner for the fund?
Yeah.
So it was sort of an easier decision for you. I mean, if you're on the board and if you're looking at it from the perspective of the fund, although you want to also look at the perspective of the founder.
As a seed investor, I was very aligned with the founder on like it's a meaningful return rather than like it's just another turn on capital.
I don't know if you remember Clubhouse, which which got an acquisition offer of $4 billion from the previous version of Twitter. and they went and raised the similar amounts from A16Z at a similar valuation. And, when COVID dropped, the sort of hype for audio products, I guess, dropped, and everyone sort of featureized Clubhouse. Twitter has a version of it incorporated in it. Every product tried having it, but I think Twitter only has it now. Even LinkedIn at one point had it. Discord has it, I think. But they got featureized essentially, and I guess they'll have to spend the 100 million they raised to find a pivot that might actually help them, find the next billion-dollar idea. But at that time, the rational choice, even if you think, because you've only spent 2 years into the company, the rational choice is to sell the company, Like
I think it is. Like, I guess that's sort of the point I'm making is like, just because Clubhouse got featureized and what we saw in the long term was that there was not any long-term residual enterprise value does not mean that it should be viewed as a failure or a fool's errand. Like, there were other ways where it's like you realize that you created something of value that there were buyers for. Like,
yeah,
but recognize, like, something does not have to exist on its own in perpetuity to be successful, to be worth the journey. And I think we sort of lost sight over the past decade in that those other alternatives are very real and very valuable. Like, it almost became a bad thing to sell your company. It's like, you sell out, like, what? And instead it's like, no, the chip on your shoulder is build a unicorn. Now we have hundreds of unicorns that are going to go to zero.
yeah. I mean, one more point, and we'll shift to foundations. Is I think this is also the time, I think, and you were sort of a founder of a previous generation, where secondaries were huge, because you're getting so much capital at inflated valuations. I think the other winners were founders who were shrewd enough to make the rational choice of taking more secondaries. I think that was also an interesting trend, which will probably not happen as much now that we're in a high interest era.
Yeah, that I think you need to be able to keep founders properly incented. So I expect some semblance of secondaries to continue. And in recent years, I have seen it continue, but not to the same extent. But there are things like, okay, look, like, if you're going to take a big swing here, let's make sure you can buy a house that your life is comfortable. Like, that is important.
And that was a trend that was existing all along, right? It was not a new trend that happened in 2020. I think the new thing was where you can take like 100 million out of the company. That was a new trend.
It got nutty.
Okay, so moving to foundations. Fun little fact was, I was Techstars mentor for last 2 batches before it got shut down, Techstars Seattle. So I saw this story a little bit closely, and I can relate to how important Techstars, that space. And I remember, I think Founders Co-op was actually situated just behind Techstars Seattle, and so it was actually one of the sort of anchor points for the Seattle startup community to come together, hang out, meet, interesting people from different generations, successful founders, successful investors, and the newcomers can, come and meet, and operators like me can come and, see what's happening in startup ecosystem, or like do angel investments, etc. And it got shut down. There were some legal suits behind the scenes, which we're not going to touch upon. But I felt that obviously, I think Seattle is probably like second or third after SF, in terms of talent and, the amount of companies we can create, but we are all somehow not living up to that potential in different forms. And we can talk about that as well. But talk to me about, why you started Foundations, what is it going to be, and what is the goal for it?
The general thesis behind it is that Seattle should be a much better place to be a founder than it is. Just starting from that recognition. And coming out of COVID, with the rise of large language models, it was embarrassing to watch sort of the phoenix of SF proper, with YC leading the charge. And when we're sitting here and be like, we're not going to replicate that, but the difference is insulting. So I went on a listening tour, reaching out to founders in the area and taking advantage of the fact that so many people moved to Seattle during COVID, or transitioned from Big Co to starting a company during COVID, and were extremely under networked and were feeling lost. And what I was finding was this desire to work and build around others, to engage in a community, but also this desire to leave Seattle, which was not a good thing for our ecosystem. So I went back in reflection to why did Techstars come to Seattle in the first place? What was going on back in 2010? What worked and what didn't? So at that point in time, there was something that rhymes with today, which was it was the rise of cloud and the rise of the SaaS business. I know it sounds ridiculous to say the rise of these things, but these things did not exist. And because of them, there was this new wave of founders and companies who were excited to be able to build things that they couldn't build before or couldn't build as easily, and be able to actually like build a business around it because of new innovations around how you charge folks, people buy software, how they use software. But there are no best practices. Like where magic came from was people working in real time around each other and sharing knowledge. That rhymes exactly with what we're experiencing with large language models right now. You're seeing the same archetypes of people doing very similar things, moving at very similar paces. And so back then in Seattle, there was a space that Founders Co-op and Techstars anchored in the middle of what is now Amazon's part of SLU. And it was a mixture of co-working space, had an accelerator going. But what it did is it catalyzed the community. And the way that it did that, and I think what every startup ecosystem needs, is some anchor point plus rhythms that allow the earliest stage of folks, the folks who are just getting started, the folks who are actively building and are way too fucking busy to network, but still need to, and also have things to learn and things to share. And then the people who have been there and have done that. So exited or, moved on in career, yada, yada. You need to get all those people in the exact same place at the same time, but they're going to be there for different reasons with different needs. And when you can do that, magic happens. And so the idea for Foundations was, can we do that? And can we kickstart a flywheel that'll make Seattle a better place to be a founder? And so the ingredients that we took together was, we need to anchor this around a physical space because that's something that all three of those categories needs right now. And that's unique because of COVID. Even people who are currently operating, you may still have a remote company, and some days you need an office, or you want to be in an office around other people. For those other folks who have been there or done that, you have very similar needs. Or I live on the east side in Seattle, and I need to come downtown for a meeting, and I'd love a place to work out of. And then obviously those early stage folks just want to work around each other. So we created all these different rhythms, and it's anchored by events, an entrepreneur in residence program, and all these things to get people together and building. So far so good. And what we've sort of said as our goal is to help people quickly on their way, get them going, get them building. So I view success as we've had one founder who went down and did YC, other founders stayed down there. They started hiring down there. 2 weeks ago, he packed up his car and moved back to the Bay. But we were the supportive community that made it so that he wasn't isolated or alone and helped him get to that decision that he needed to leave Seattle and move down to the Bay. We have other folks who have been thinking about leaving Seattle and instead feel like, I feel like I've actually found a home in a community, I've gotten connected, and this is where I'm going to stay. And so far it's been a great success, but it is an iterative mission. The way that I'm describing it is a invite-only community of founders, and our goal is to serve the founder community in Seattle and make this just a much better place to start a company. So, you said that like after, SF, Seattle should be 2 or 3. There's one thing that's weird about Seattle. Where like cities like Austin, New York, Denver, they're geographically detached from the Bay, and the companies and cultures there are not the ones that are sort of mirrored on the West Coast. And what I mean by that is like so many West Coast companies have their Seattle office and their SF office. It's a short flight. Like people work at the same companies. Everyone's sort of connected. Like we are like a weird shadow community where I also feel at the same time like what Techstars is trying to do of being like, hey, we're the accelerator for, the others, for the non, tech market. Like that didn't make any sense here anymore because it's like, no, like it's just, there's 20 flights a day on Alaska, another 20 on Delta. I know dozens of people in either area. Like my current employer has offices in both locations. Like we were too connected for that value proposition. And I think that was different back in 2010 when Techstars started. So part of the thought with foundations was like, it's not an accelerator because I believe that wasn't the most important thing for us at the moment. What we just needed was something to get people together, and as part of a community.
Got it. So you're doing foundations, but have you thought about like what other things should exist in Seattle to sort of live up to the expectations of what Seattle should be?
Yeah. There's one very real thing, which is, and I've had this conversation a lot now over the past month, and there used to be an organization called Venture Out in Seattle, which was sort of a pre-accelerator designed to help people leave their big tech companies to start a startup that didn't work for a variety of reasons, and COVID was a big one of them. But I'm focused on people who have already taken the leap and are founders. But I think there is a very big need for sort of the everything from founder matching to the sort of incubation required to get people out from big. So what's so weird about Seattle is we have more venture studios than venture funds. And I think that's because a lot of people who have been at big companies, it's like a more comfortable path for them to then go inside of a studio rather than like just being, out to sea and like, holy shit, what did I just do? But I think that we should also have another product here, whether it's, because going to the, now there's AI Tinker events all over the world, but going to those events, there's just seeing all these people who are not quite founders, but the sort of rise of large language models has been enough of a catalyst for them to say, I actually want to go out and start my own thing. And so we're starting to do some stuff at foundations in terms of just like events for those folks. But I think there's room for something more structured that could look like an accelerator that is not quite what Venture Out was, not quite what Techstars was, that sort of solves for that.
One thing I also think that is missing is we don't have a lot of quick, you sort of alluded to it, we don't have enough pre-seed funds which write quick, small checks in terms of like how much talent we have. Like we have more studio models where it takes longer to get that first pre-seed check to get things going.
Like it's not that hard to raise that money from the Bay. And that's where I think like having a little bit more structure where somebody who's not quite at the accelerator level can take advantage of what an accelerator does, which is rapidly grow your network. Because I think you just need to get plugged into a couple nodes and you fly down to SF and I think you can get it done. What we don't have, and this is that I think would be helpful, but will take time, is in the Bay Area, you have tons of folks who made their money on startups and, 50, 100K checks just fall out of their genes to people who remind them of themselves when they were just getting started. The people who made money in Seattle made it by never leaving Microsoft or never leaving Amazon, and they buy boats and houses on lakes and golf. Their hobby is not investing in startups, nor should it be, because it's not what they know. And yeah, like we are starting to see those exits. We are starting to see people have that money, but we don't have 1/100th of what there is in the Bay Area. And so I think we just need to keep investing in our startup community, keep building things like I'm trying to do with foundations. And 5 to 10 years from now, there will be a lot more folks who have had those exits and can write those really quick, easy checks where they're not asking for a business model or a deck. They're just looking at the human and saying like, I've been where you are. I want to be part of your journey. Like I'm already gonna like chat with you monthly, like, and be a mentor. And if I'm gonna invest my time, I might as well also give you 100K because that's nothing for me because I'm worth $500 million.
Yeah, I think what Foundations is doing is a good start, and I think we need many more different initiatives from different folks. I ask all my guests a set of questions at the end. So quick, quick questions just to get to know a little bit more. So I think, what you're consuming is, what you become. So what are you consuming right now? Books or podcasts or Netflix? What is influencing your thinking?
Man, as someone who has multiple jobs and an 8-year-old, you would be surprised and how much I can consume outside of what I do. But let's say podcasts.
It doesn't have to be something intellectual.
Yes, I listen to a wide variety of things. Like I tend to listen to just on daily walks. I listen to All In. I listen to Rogan. I listen to Jordan Peterson. And then I just will pick up random other things that show up in my feed. You know, let's see, movies and things. Like, I love sci-fi, so I pretty much watch every sci-fi show that is out there. And books, I think it's been a year since I've sat down with a good book, but I got reminded to reread the Courage to Be Disliked by it going viral again last year, and I would highly recommend that book. Is just like a constant reminder to anyone who's ambitious to, I'd say ambitious plus likes doing right by other people, to read that book at least once, if not put it on like a common rotation.
What do you know about investing that you wish you knew when you first started out?
Say that, like, the feedback loops on investing are really, really long. So I am a builder. Like, I started my career as a software engineer. Like, I had a crazy detour during COVID of buying a farm, which was really fun, like working on a tractor, learning how to do all that. Like, I like being able to impact the world, learn something, do it again. Like, when we built foundations, like, I was the general contractor. Like, I was doing electrical. I was doing like everything. And I love doing that stuff. But as an investor, if you try to do more than you should, you fuck things up. Because you are not the co-founder, you are not the operator, you're the investor. So you need to, if you are the type of person who really needs the dopamine hit of having an impact, you need to find other places in your life, place that energy, and hopefully you can find ways that make that accretive to your work as a VC. And that doesn't look like just shit posting on Twitter, because that's what I see a lot of people do with that energy.
Yeah, I think that's a good note to end the conversation. Thanks, Aviel. Thanks for coming on the show and sharing your thoughts, and hope foundations will become sort of an anchor for Seattle ecosystem.